Welcome everyone to EnergyLab's first public online event on our shiny new event platform, Hopin. Today we're hosting a panel discussion on investing in startups to progress the Sustainable Development Goals, and we've got a great panel for you today. But before we go any further, I'd like to acknowledge the traditional custodians of the various lands on which we work today and the Aboriginal and Torres Strait Islander people watching this webinar. I pay my respects to elders past, present and emerging, and recognise and celebrate the diversity of Aboriginal people and their ongoing cultures and connections to the lands and waters of Australia. For those of you not so familiar with EnergyLab, I'd best quickly explain who we are and what we do. So EnergyLab is Australia's largest clean tech startup accelerator and network dedicated to the clean energy transition. We connect founders to the mentors, partners and investors they need to succeed. Now, most of that is done through a collection of programs, each of which are targeted at a given stage in the startup journey, from no idea at all to acquiring those first paying customers, all the way to raising capital and scaling up. We also like to initiate conversations, facilitate new connections, and try to uncover opportunities for startups. I'm sure many of you watching this will have attended in-person events last year, and I'm sorry that today you have to supply your own cheese and wine. Now, on to today. If you're new to Hopin, you're currently watching the stage area. So on the right-hand side is the chat panel, and this is where I'd like you to type questions, which peers will then come to in the Q&A at the end, and put that in the event section. On the left-hand side is a panel where you can also navigate to the networking feature. So if you'd like to meet other attendees watching today, then head over to the networking area to enter into randomized one-on-one chats with others who are also looking to network. And we'll wrap up at 1:50 to make sure there's enough time for you to do that. So now that's enough from me. Without further ado, I'd now like to welcome on screen our facilitator for today's panel, EnergyLab Chair Piers Grove, along with our three panelists. On the panel today, we have Sally McCutcheon, CEO and Executive Director of Impact Investing Australia. We have Rachel Yang, Giant Leap Fund Investment Manager and from Impact Investment Group. And finally, James Tilbury, EnergyLab's CEO. So Piers, over to you. Where's Piers?
I also have the first question if you want me to jump in, because it's to
Go
Rachel.
for it. Do your intros.
Okay, so I'll ask Rachel the first question. Rachel, could maybe you start by giving us a quick overview of what the Impact Investment Group does, and particularly the Giant Leap Fund and your role there?
Sure, thanks, Sally. So the Impact Investment Group is a funds manager, and our mission is to shift more capital towards investments that blend financial return and social and environmental benefit. So our view is that you don't need to trade off one for the other, and ensuring that people can understand that they can use impact as a lens to how they make investments. Now, we do that across three divisions, so property, renewable infrastructure and venture capital. I sit within the venture capital team, and our first fund is the Giant Leap Fund, and we are investing in startups across three themes, so health and wellbeing, sustainable living and empowering people. Great to see Piers here.
Piers is
I'm becoming a baby boomer every single day.
I'll let you take over from here, Piers. So we've just had an intro from Rachel, which is the first point on our run sheet, and now we'll go to Sally. So if you could briefly explain what Impact Investing Australia's mission is and how you go about implementing it, and I'll let you take it from here, Piers.
Yeah, sure. So I might just take a quick step back and say that Impact Investing Australia is a market building organisation. We're a member of a global group called the Global Steering Group for Impact Investing. Our mission is basically to grow the impact investing market in Australia and from Australia. And we've incubated a number of market building initiatives, including an investor survey, a benchmarking report, which are now produced by RIA, which is the Responsible Investment Association of Australasia. We do a lot of advocacy to government, and one of the key initiatives we're working on at the moment is a big impact investment wholesaler. And we also run what's called an Impact Investment Ready Growth Grant, which helps earlier stage social enterprises pay for capacity building so they can actually go out and raise capital.
Fabulous. Thank you very much, Sally. And finally, James, I think Adam's given us a good overview of EnergyLab as an organisation. But this report that you prepared around the SDGs, would you mind just giving us an overview of the scope and insight?
Yeah, sure thing. So we, just over a month ago now, released a report called Clean Tech Startups and the SDGs, a taxonomy and state of play for impact investors. Now, as the title of the report suggests, there's two main sections to the report. We've got the taxonomy, which is essentially a fancy word to say a table with 37 categories of clean tech startups that we've identified. They're quite distinct. And then kind of the environmental SDGs that they are most relevant for. So you can look at the primary SDG that they impact. Then you've got secondary SDGs they also impact, as well as clarifying which ones they're not so relevant for. And the reason we put that together is to make it easier for people who want to back startups or care about startups to quickly identify which ones are most relevant to the SDGs that they care about. We might touch a bit more on that later. Then the second half of the report, we essentially ran our database of over 300 Australian clean tech startups through that taxonomy. And there are some insights which I might just read out because I think they'll be quite interesting to some people listening. So first, when you look at the SDG that clean tech startups in Australia primarily focus on, the most relevant for, over 2/3 are most relevant for SDG 7. That's the affordable and clean energy SDG, for those who haven't memorized the SDG numbers. However, if you look at the secondary impacts, so this takes into account things like decarbonising energy to reduce climate change, which has flow-on impacts to biodiversity and ocean life, it's actually SDG 14, life below water, that most clean tech startups actually impact. So more than 90% of clean tech startups in Australia have a beneficial impact on life below water in the broader SDG 14. We also, a couple more stats I'll just read out. We also looked at the deep tech, deep tech startups. So for those familiar, deep tech vaguely means a startup that's commercializing technology that has been developed at a university or some other research and development lab. And by our definition, at least, only about 10% of clean tech startups in Australia are also deep tech startups. And we think that's a bit of a problem given how much really valuable IP our universities are creating around this area. And one last statistic, it looks like, based on our survey, that less than 20% of clean tech startups are led by women, which is obviously too low and something we're doing our small part to address through various initiatives like our Women in Clean Energy Fellowship.
Thank you, James. And I've also just placed a link to the report into the chat area. I'm sure you've all read it well in advance of the session, but if you missed a piece, you can grab it again there. Rachel, in terms of the Giant Leap Fund, you're running a fairly sophisticated ruler over your investments, I understand, from that impact perspective. Does the SDGs fit into that assessment framework? And perhaps you can explain a little bit about the broader framework as well.
Yeah, sure. So I'll start with how we look at impact in assessing effectively an impact hurdle when we review each opportunity that comes to Giant Leap. So we start by looking at whether impact is embedded in the business model. So whether that is, each dollar of revenue generates effectively a unit of impact, whatever that may be for the startup. So, for example, in waste, we're invested in a business called GoTerra that breeds black soldier flies to consume organic waste, so effectively a maggot farm. Mm-hmm. And embedded in their business model is waste management, so reducing waste from landfill. And so the metric itself that we identified when we were considering the business was tons of waste diverted from landfill. So very simple. And that's kind of how we look at, is it embedded in the business model and can we come up with a metric? Then once we get further past that hurdle and do more into the impact due diligence, we use the impact management project framework. So that is basically a framework that's quite simple, that's been developed by a number of different practitioners in the impact investment industry. And I'm sure Sally could talk more about that. But there are different elements to it, which are who are the beneficiaries of the impact? So that's one area we consider. What's the impact itself? How much impact is being generated by these startups that we're looking at? And then what is our contribution? So if our investment wasn't to take place, what would be the baseline? And then what does our investment do to catalyse the impact? And then lastly is the unintended consequences, so the risks. So something that we think about quite deeply is that you might think you're doing something good, but then there might be a flow-on effect that is actually negative. So your net impact may be either nil or negative. And so that's something we really think about. And so the next part of that framework is really looking at they call, it's referred to as the ABC concept, and kind of avoid harm, benefit people and planet, or contribute to solutions. So that's the kind of sliding scale of where, after considering all those 5 factors, where you might sit with that specific investment.
This is a bit of a tangent, but you must have looked at a lot of investments through that lens, and you're also got to be looking at financial performance alongside that. From what you've seen, are good sustainable businesses also good investments, or is it almost inherent that you need to take a hit on performance in order to make a quality ABC investment?
So for Giant Leap, we don't see there being a trade-off in the businesses we invest in. I think the challenge is that impact itself is very subjective. And so you might think about the depth of impact and and also financial returns are subjective and depending on the investment mandate. So I guess it's balancing those elements and ensuring that the impact aligns with the intention, as does the financial returns with the targets.
Okay, that's excellent. James, in terms of, obviously Giant Leap have got a very good approach to assessing and making these investments, but your report sets out a taxonomy, as you said, a table, to help create a lens. How can other investors potentially use that taxonomy for their own assessments?
Well, I'm not sure if it'd be useful for the Giant Leap Fund. They seem to, really have their processes here, but there might be others who are a bit newer to the space who might find it useful, and it's probably easiest to explain an example. So shortly after we released the report, a VC fund in the UK who have hundreds of millions under management reached out to see if it could be useful for their internal processes. So they're quite fortunate of their investment dollars come from family offices that want to have a positive impact on very specific SDGs. There are a lot of SDGs, as many people will be aware of, and they've picked a few that they want to have a particular impact on. The challenge for them is that in order to deploy hundreds of millions of dollars, they need to vet or at least consider thousands of startups over the investment period of that fund. And so that's quite a large challenge, and it's hard enough to do that when you're just optimizing for financial rewards, but when you're optimizing for social environmental impact as well, that becomes even more challenging. And so what they're hoping that the taxonomy could do is to help them quickly assess how likely a particular startup is to be in line with their various SDGs that they're targeting, just to make that process more efficient so they can focus on those. And that's not unusual for the finance sector in general. There are other taxonomies, such as in the UK and in Europe and around the world, that help make kind of sustainable investment decisions.
Do you think it's also, I mean, we've spoken about this largely from the investor's perspective, do startup founders do themselves a service by helping frame the impact of their own startup so that investors don't have to start from zero?
I think it very depends on the investors they're trying to target. And I think we're in a bit of a transition point as a society around investor opinion on kind of impact startups. And Rachel, I love your opinion on this. I feel like kind of some time ago, a lot of investors had the opinion that if you're having a positive social environmental impact, you weren't going to generate the same returns. Now, like Rachel, I don't believe that to be true at all, particularly in certain sectors like the clean energy sector. But we seem to more and more mainstream investors these days are looking to achieve both, like a Giant Leap. So Giant Leap have been doing this for a long time. Others seem to be coming along that journey, following along to take a similar view. So I think I can't give a clear answer to all the startups watching today because it depends, but I think we're moving to a point where it would be beneficial for startups to be a bit more out and proud about the positive social and environmental impact they're having on the world on that, in order to attract both not just investment, but also broader support for what they're trying to do.
So just for my own benefit, you're saying that there are still some investors who, if they see a startup pitching and talking about their impact or their contribution to SDGs, assume that they're going to take a performance hit and run away.
I think there are still some investors out there. I'm not so sure around VCs, but definitely some angel investors who have those biases that we've talked to. They seem to be changing their mind over time, which is great. But we seem to be, at least from my perspective, from the angel groups that I talk to, that we seem to be in that position in society.
Yeah, yeah. Sally, can I bring you in from a slightly broader, holistic view of the industry? We're talking here, I think, a lot about investing into Australian startups and measuring that impact. But as investors within Australia, looking internationally, is there a role for Australians investing from Australia but globally?
Yeah, so I think it's a very good question, and we actually wrote a report last year that addressed impact investing and tackling the SDGs from Australia and some of the challenges in doing that. I think when you get into the startup space, one of the issues is always about risk, and I'm sure Rachel can talk a lot about this, but for many investors, investing in startups are seen as being quite high risk. And when you take that to startups in a geography that, as an Australian investor, you might not necessarily understand, your perception of risk is really heightened and compounded by that. It can also be compounded by differences in, government policies, by a lack of intermediaries in or fund managers in the market that you're trying to invest in, regulatory issues, all sorts of things. So often you see that, particularly in developing markets, investors tend to go more for debt-based instruments as opposed to equity, because the debt is seen as slightly lower risk in what is markets that aren't really understood. There's some good managers that are starting to operate and support startups in developing markets, in Asia Pacific in particular. Two kind of jump out to me. One is Panama, which is looking at regions like Cambodia, Indonesia, etc. And another one is SEAF, which is based out of Singapore and has also got a Southeast Asian remit. They both also look at gender lens as one of the overlays to their investment process, which I think is interesting. The other groups that are really looking at this space are the multilateral development banks and the development finance institutions, and they've also established funds in this space. They're providing both technical assistance to some of the startups and also investment as well. And the final thing probably worth thinking about is some of the initiatives that DFAT is doing around scaling frontier innovation, which is helping to support entrepreneurs as well as intermediaries and brokers, and also supporting blended finance into these markets. And as I'm sure many people would appreciate, particularly in the early stages of startups, it's very hard to make a commercial return to the point of trade-offs. I think often you do need some sort of blend, and then as the business evolves, it can and scales, it can move into that commercial return space. So Convergence is an organisation out of Canada that's looking to build more blended financing options. So I might just leave it there. I could actually go on all day, but I might just leave it there.
We've talked about this very much from an Australian perspective, and I think that makes sense. Is there a lot of coordination at a global level, particularly when it does come to supporting these more developing markets? Is there good enough coordination, or do we run our own game in Australia?
There is some very good global networks that support startup organisations internationally. There's ANDI, which is the Aspen Network for Social Entrepreneurs, or Network for Entrepreneurs, which is almost a peer-to-peer network that provides support for entrepreneurs. There's groups like the Collaborative for Frontier Finance that's looking at the intermediation more on a global basis. There's some large-scale foundational support that, for example, some of the bigger foundations in the US, like MacArthur and Rockefeller, have got together to form alliances around supporting earlier stage social enterprise. So there's a lot of things going on through organisations like the GSG that I explained that we're part of, the GIN, which is the Global Impact Investment Network. There's lots of activities going on and support going on. and there's potentially opportunities for people to engage. I mean, Tonic's another one for investors, which I know Rachel will know about us. So there's many opportunities if people are keen to engage in the developing markets.
I'm going to change tack. We've spoken about setting up the framework for impact and being able to quantify it and check it. But how do you make sure it's actually being delivered once the investment is made? How do you, as a group, keep track of the performance and impact of your portfolio, Rachel?
So we request the data from our portfolio companies. And so the starting point is actually with our Chief Impact Officer, Dr. Erin Quos. She works with us and makes sure that initially the impact metric is straightforward, and then the data that can be captured on that is also easy for the business itself to capture. And so there's not a lot of, I guess, need for an intense audit or anything like that, because the data is straightforward. It's inherent in their business model. And so if the revenue's going up, you'd assume the impact's going up as well. So we just sense check the information that's provided by our portfolio companies, and we request that on a quarterly basis, and then we aggregate at the annual level to then report in our annual impact report. And one thing I didn't mention before around the SDGs, whilst we have a different lens at looking at assessing impact, we then aggregate up the impact when we report from an annual perspective to the SDGs, as it is something that's very commonly spoken about and something that a lot of people can relate to. And we thought it would be helpful to then aggregate at that level from a reporting perspective.
The impact report that you put out last year is fabulous. Is there a way that others can see that, or is that?
Yeah, sure. I can pop the link in the chat as we're speaking. Sure, it's basically pretty easy to find just on our Impact Investment Group website, but I'll pull that up as we're chatting.
That's what I was hinting at. Thank you very much, James. In terms of working with the startups as you do at EnergyLab, are you seeing that they're building in some accountability around impact alongside their financial performance?
Well, first to say, I know there's a whole bunch of the startups we work with and other entrepreneurs on the line. So everyone, feel free to comment in the chat box if your startup is doing something around this. But from my experience, the short answer is no, and not because they don't care. They definitely do care. It's the reason the social environmental impact is one of the main motivators for most of the entrepreneurs that we work with. But I think it comes down largely to Rachel's point, is that it's actually not that hard. I mean, if revenue is going up, as long as you've aligned your business with a particular social environmental outcome, your impact should be going up at the same time. That's not universally applicable, but it's applicable in a surprisingly large proportion of cases, and particularly in the clean energy sector that we focus on. If you're selling more solar panels in general, you're helping to reduce more emissions. But I also think there's a couple other factors here, in addition to what Rachel's very good point about that being aligned. One is just startups are time poor. They could be spending time measuring all their impact, but they would probably be better off growing their business and having an impact. And it comes down to the question of what are they actually going to do with the information that they might get from those impact measurements. They might need to do a kind of a base level, and that might be good for communicating to staff, communicating to investors. But they probably don't want to spend too much time. And the trick is that really good impact measurement can take a lot of time. And I think an example here is in Tesla. So if you look at the impact in Tesla, a straightforward approach might be look at the number of vehicles they sold, and then look at the difference in emissions from the electricity those vehicles consume versus the emissions from driving an equivalent ICE vehicle. And the difference there would be the impact on mitigating climate change. But the thing is, that doesn't really even scratch the surface of Tesla's impact. For starters, it's not just the cars they sell, it's the fact that they've completely changed the perception of EVs in consumers' minds around the world. And they've also forced the hands of other automakers to kind of ramp up their production, the design and production of electric vehicles. So it's not just the Tesla vehicles on the road that they can take credit for, it's also some proportion of other automakers' vehicles on the road. And who knows what proportion that is. It gets a lot murkier, a lot harder. And that doesn't even go into all the flow-on impact impacts of helping decarbonise the grid. So it can actually be quite tricky for some of the best clean tech startups, because what they're trying to do is not just sell more product, they're trying to have a transformational impact on the economy. And so actually putting a single number on that can be quite hard. So I think there's definitely value in it, but from what we've seen, a lot of startups, it's kind of built into their DNA more than something they tag on as an annual reporting figure.
And Sally, in terms of measurement, are there any lessons that we've seen in other markets around how to report back on that impact side for founders?
Yeah, it's another pretty big question. So I'll try. I think it's a really good point that both James and Rachel have made about the cost of the impact reporting, and I think the way we often think about it, because collecting data is actually one of the biggest challenges, particularly for some of the social data as well. And we tend to think about making sure that people are thinking about the impact from a management reporting perspective. So what do you need to actually, build and drive your impact in the way that you would do your management accounts? And then what are the metrics that you need to report it to other people? So we kind of like to think about those two things differently, because you might only need to report 3 metrics to be attractive to investors, but you might actually need a few more to actually be managing the business. But in terms of our involvement in this space and some of the other things that are out there, it's a very big and growing field. So as members of the GSG, we're very connected, as Rachel alluded to earlier, with the Impact Management Project. And the Impact Management Project has got together, under the banner of the Impact Management Project Structured Network, a whole group of international multilateral organisations, from the UNDP to the Global Reporting Initiative to the Sustainable Accounting Board, Standards Board, to the GIN that I mentioned earlier, to the International Finance Corp, to the World Benchmarking Alliance and the OECD. So there's a lot of people working together. They're working on 3 key areas, which I think it's worth people sort of thinking about in terms of startups and practice. One is the process for managing impact. So how you align your business, to Rachel and James's points, how you kind of align your business to an impact way of thinking. And that's what are the, what's the strategy, what's the business operations, what are the things that you put into practice to make sure that your organisation is generating impact. And there's a body of work going on around that that's led by UNDP under the banner of the UN SDG Impact Initiative, and they're putting out some standards. The enterprise standard is coming out later this year. They've already done private equity standards and bond standards, and that is helping people think through the process around how they actually embed impact into the business. The next area is around performance, and that goes more to the kind of metrics that you might use in the SDG conversation that we're talking about. Just 2 examples of that. One is the Sustainable Accounting Standards Board, and they have a 5-dimensional framework that takes into account environment, human capital, social capital, governance and leadership, and business operations and innovation. And they actually have metrics underneath that, and they've done a mapping to the SDGs around that. The second one is the a GIN initiative, which is called IRIS Plus. That's actually quite good for businesses that want to look at either the SDGs specifically, an SDG specifically that they want to target, or they want to just target a particular impact area, like for example biodiversity. So you can select that, and the GIN has a whole range of potentially applicable metrics to that particular impact area. So that's something that you can go online, you can have a look at, and you can select impact metrics that might be applicable. Mm-hmm. And then the third area is around the reporting aspect that I mentioned, and the comparability. And one of the organisations that is working in that space is the global the World Benchmarking Alliance, and they are looking at comparability across industries. So at the moment, they're doing a piece of work that's looking at 400 financial institutions globally and comparing the impact of those different organisations against a standardised set of metrics. So that's all to say that there's a lot of stuff going on. there's a lot of resources out there that can potentially be accessed, and there's lots of websites that you can go on. But I think a good place to start would be the Iris Plus for startups.
James, I'm going to come back to you and ask from the point of view of EnergyLab. There's a whole heap of startups that you see apply or participate in programs each year. Are people necessarily starting startups to have the impact, or can sometimes the impact be secondary to what they just see as being a really useful business model and a successful business model?
Oh, it's a great question. We probably should collect some stats on this when we apply for various programs, because I'll be interested in the exact breakdown. But my sense from talking to people is there's definitely people in both camps. So we have some very successful entrepreneurs who have come from another sector who aren't necessarily in it for the impact. They might like the fact they're having impact and they might find that motivating, but really they just saw an opportunity. So they might have come from the telecom sector and realized that they do things well in that sector that could be done better in the energy sector, or their skills are applicable. They saw the sector is transforming and they're jumping into that. So there's definitely people who just, because they see the opportunity in the sector. I think there are also a very large group of people who want to have a positive impact on the world, and for various social environmental problems, and some of the most popular ones are climate change and oceans and within the environmental sector, and then they look for opportunities within that. And as large as that group is, I think that's probably the harder path to go down, because you're really constraining the universe of potential startup ideas, and then trying to find something that's financially viable within that universe of impactful startup ideas, which is why we said, as a quick plug, we run programs like our Women in Clean Energy Fellowship that I mentioned earlier, that applications are currently open for, and helps people understand the industry in enough depth that they can then identify good ideas that are going to be profitable and impactful.
Rachel, does intent matter when you're assessing an investment? Does whether they're driven by impact or profit actually matter to you, as long as the impact is actually there?
Yeah, intent does matter a lot for us, because for our fund and the way that we work, we're investing at the very early stages, and we're investing in people. Predominantly people are the focus for us, because there's not a lot else there at the very early stages in terms of a business. There's a bit of traction, but ultimately they won't be able to grow and scale if the people aren't the right fit. And impact needs to be at the core for us. And so that usually is pretty easy to be interlinked, because the problem that they've chosen to solve tends to be a problem close to their hearts. So inevitably the intent usually is there anyway, because of the problem that they're seeking to solve has a personal connection for them. So the reason it's important as well is that it goes to the mission of the business and ensuring that they stay focused and want to continue to grow the business. And if they're really focused on that impact, then the motivation will continue to be there as the times get tough, as they inevitably will with the early stage business.
I might come back to Sally and just broaden that out. And what is the interest in this as a lens for investing? Are we seeing more people? Is there a type or a demographic that's being attracted to this? What sort of trends are you seeing, Sally?
So we're definitely seeing more. I think going back to Rachel's discussion around the impact management project. So when Rachel was talking about the A, B and C, which is the avoid harm, benefit stakeholders and contribute to solutions, that sort of relates to the depth of the impact, as she was saying. So ESG type investment products, so if everyone's familiar with those, environmental, social governance, screened products would fall into the A, which is avoid harm. So you were running an equities fund and you were taking out tobacco and alcohol and weapons of mass destruction and fossil fuels, that would actually fall into the avoid harm category of impact investing. And I think a lot of people are now starting to move into really looking to select products on the basis of actually taking out some of that, what we describe as negative stuff. And so I do think the momentum is growing. I think it's harder to find investments in the C category, which is why what Rachel is in the startup EnergyLabs is doing, because that is creating more of those investments in that deeper impact type category. And the more of those we have, I think the more investment we'll start to see in the deeper impact. But at the moment, I think interest in investment is definitely growing. It just comes back to different levels of interest at different depths of impact.
Just following on from what Sally had said as well, and just I think it's worthwhile pointing out that with the SDGs, there are a number of very specific targets under the SDGs, and that, you know, they were focused globally in thinking about the developing world. So in the context of the more developed world and private markets, as opposed to policy and government changes, I think we need to view the SDGs in a slightly different way. And it feels like that is the trend, that people are using the SDGs as thematics to understand the broader goals and the greater goals, rather than the individual targets that sit underneath them. Because I think that can sometimes be a little bit intimidating when you start digging into the SDGs as to what those targets are and how you as a startup founder might then contribute to those. I think they might not be relevant in the context, but with the overarching goal in mind, or those 17 goals in mind, I think that's an easier way to help classify where your impact may sit.
I think it's Sally. It's a really important point that Rachel makes, in case anyone missed it, is that the SDGs, if you read them, they do have a whole bunch of goals and indicators below them, but they do not sum up the entirety of the point of that SDG. And it's very worth keeping in mind the SDGs were developed as part of a diplomatic, democratic process, not from someone thinking very logically from first principles. I'm sure that lots of people like that in the process, but the outcome isn't perfectly, I guess, coherent necessarily, and I must say that in the kindest possible way. And so a lot of, to expand on what Rachel was saying, as part of the Australian Sustainable Finance Initiative, which Sally and I, and potentially you, Rachel, I'm not sure, are a part of. That's the approach that a lot of investors, institutional investors in Australia, are taking, saying, well, the climate change SDG is obviously about mitigating climate change, but if you actually look at the specific goals below it, there aren't actually too many that say specifically going to reduce emissions by X. It's kind of implied by the SDG.
Yeah, I think that's completely right. And I think, yes, I didn't mean to say that people are reporting specifically against the indicators. They're much more reporting against the actual alignment to a particular SDG. And I think that's really underpinned by the fact that even like UNSCAP, I don't know if people know, they're reporting the ESG progress in the Asia Pacific. And even they say, you know, we can't, like something like greater than 50% of the indicators, they can't even get the data for, and they're the reporting agency. So I don't think we can be realistically thinking that, you know, organisations and startups can be getting data that major global institutions can't. So.
Yeah, good point.
I can tap in and throw some questions to you guys from the chat box if you like. It appears having issues. We got one here that says, keen to hear more about the impact made on the ground by some of the portfolio companies, and is there any way to measure it with subjective terms? I'm sure you've already covered that already. Anyone want to take that?
Rachel, it's probably best for you.
Yeah, happy to take that. So as I mentioned, GoTerra, which is the waste management business, one of the metrics is, you know, tons of waste diverted from landfill. That's it, and gives you an idea. But then there are ones that we work with that are more qualitative, and that case studies are really important. So an example of that is Work 180. And so they're a platform that flips the job recruitment platform model on its head. So it's that the employers themselves are screened before they're allowed to list, and that screening for whether they support women in their careers. So things like flexible work, whether there's paternity and maternity leave, stillbirth policies, those types of things. And so their impact and our thesis is that they can really change the way workplaces, if they want to attract the best talent, they need to have improved policies to support women in their careers. And so some of the case studies that we have relate to employers actually changing those policies, and then the number of women hired that previously compared to a baseline, say they only had maybe 1 or 2 women in leadership, and now they have 5 or more, that those types of case studies help, whilst you wouldn't be able to say that entirely the attribution is towards, work 180 maybe, but they definitely contributed to that. So by showing the case studies, it can help, because I think the challenge with impact is there's often a question of attribution, because there are so many factors that influence any outcome. So our thesis is that they do influence the outcome and then can use case studies, but it is hard to say sometimes with all of the other factors in the world that the attribution is clear.
Awesome. Okay. Got another question here from James. He asks, how relevant are impacts that are wide-ranging and extend beyond the individual business? Anyone want to jump in on that one?
I'm happy to kind of follow on, and then maybe James can kind of bring in their perspectives from their view. So I think the individual businesses contribute, but I think we've got to think at the outcome level as well. So it's trying to work, and that's why the SDGs can be really useful, is thinking at broader outcomes and potential wide-ranging benefits of a business, and then thinking about what is in the realm of their control and how that contributes to a specific broader outcome. And maybe, Sally, I see you nodding, and there's probably more to it from your perspective of the frameworks that you say as well.
Awesome.
I was just going to say that, so the Sustainable Accounting Standards Board, I know it sounds boring because it's got the word accounting in it, but actually it's got some interesting conceptual stuff. And when their mapping of those concepts to the SDGs, they actually talk specifically about their concept, which builds on what the business can do, and then linking that to the SDGs looks at it, as Rachel said, from a more international and global perspective. So, the role of business and their contribution to the broader ecosystem, and I think that's particularly relevant with things like climate, because I don't think any of us are operating in isolation in terms of the impact that we're having more broadly. So, but worth having a look at that framework.
Yeah. I'm sorry to any accountants on the call.
Yes.
James,
I haven't been one of them. I can actually say that.
Do you want to weigh in on that one, James, or should we move on to the next one?
I'll have to move on to some more questions coming in.
Yeah, sure. Okay. This one, I'm probably going to ask each of you to pick your favourite. So from John, he says, out of all of the SDGs, which one can we say is the most important one to concentrate on first?
Controversial question.
James, do you want to go first? Do you have a favourite?
I'll go first. I'm happy to be controversial. I think personally that SDG 13 climate action is the most important. And the reason for that is because it impacts on the rest of the SDGs. So I'm kind of copying out by saying all of them here. So if you look at climate change, it has the obvious environmental impacts by increasing pressure on biodiversity and also increasing ocean acidification, which is important for life flow water, and all the other environmental SDGs that has impacts on those as well. And then you look at the social SDGs, climate change is going to have a huge negative social impact. And so the more we mitigate climate change, the more we're making it easier to address a lot of the social SDGs. And then, of course, there are economic aspects of the SDGs as well. It's going to be much easier to keep the economy strong if we are dealing with climate change and mitigating climate change rather than just adapting to it. So I'm happy to go out and say SDG 13.
Any advances on 13?
Any counter offers?
I'm going to say it's so highly subjective. It's such a difficult question to answer. And to James's point, they're so interrelated. But I think one that is really in the frame at the moment and so important because of where we are with COVID is health. And so, I don't think any of us are under any illusion that people that are going to be the most disadvantaged are the ones that are in developing market and in sanitation is low. So I think health is really a big one to be thinking about at the moment at this time.
Yeah, and I would agree with them both in terms of the relationships of each of them. And if you think about it in the sense of people, I think of it as Maslow's hierarchy of needs. If people don't have good health and they're experiencing extreme poverty, they're not really going to care about using a plastic bag. You know, they're caring about what they're going to eat day to day and whether or not they have a roof over their head. And so then there are negative impacts for the environment if people aren't thinking that way, because they've got to just survive. And so social and environmental are intrinsically linked. And I think the challenge is, because some people feel more skewed to social or some to environmental, that there tends to be people and funds and investors that try to focus on one area. But and there's nothing wrong with that. It's just that my view is they're all linked. So it's hard to kind of pull them apart.
Okay, so I think that's all from us for today, and Piers. Not sure what happened to him towards the end. But we'll say goodbye from him on his behalf. But yeah, thank you again to all three of you for joining, and Piers for joining us today. And thank you all for coming and watching.